So you know what a W-2 is, right? That form you get from your job every year? Well, I want you to imagine a W-2 that's built for the entire global economy, one that has to track money flowing across borders. That's pretty much what Form 1042S is. And today, we're going to pull back the curtain on this powerhouse of international tax reporting. Here's how we're going to break it down. First, we'll look at the basic blueprint of the form itself. Then, we'll meet the key players, who's sending it and who's getting it. After that, we dive into the real engine, the crucial difference between what's called Chapter 3 and Chapter 4 withholding. Then we'll cover the data, a massive change in how you file coming up in 2026, and finally, we'll talk about the stakes, because they are high. All right, let's start with the blueprint. Before we get lost in the details, we really need to get our heads around the whole point of this form. You know, why does it even exist? What's its job in the US tax system? Okay, see that phrase? Information return. That is the absolute key. This form's main job isn't to be a tax bill. It's to report information to the IRS. And this is so important. You have to file it even if zero tax was withheld, maybe because of a tax treaty or some other exemption. At the end of the day, the government just wants to track the money. So every single Form 1042S is born from a specific relationship, a transaction between two parties. Let's get to know the two main characters in this story, the one paying the money and the one getting it. Now, when you hear withholding agent, you might picture a huge bank or a multinational corporation, right? But the actual definition is way, way broader than that. Seriously, if you're just an individual who owns a rental property and you pay a foreign contractor to fix the roof, guess what? You could be a withholding agent. It's all about who has control over that payment. And on the other side of the transaction, you have the foreign person. This is basically anyone who isn't a US person, so not a US citizen or a resident alien. And again, the scope here is massive. It could be anyone from a foreign student getting a scholarship to a huge international company that's earning royalties from the US. And this comparison chart just lays it out perfectly. The withholding agent is the one doing all the work. They control the money, they withhold the tax, and they file the form with the IRS. The foreign person is on the receiving end. For them, the 1042S is their proof of income and taxes paid. It's the document they need to file their own taxes, and maybe even claim a refund if too much was taken out. Okay, now we're getting to the real heart of the matter. This is the analytical core of this entire system. See, the requirement to withhold tax isn't just one simple rule. It's actually driven by two totally separate parts of the tax code, known simply as Chapter 3 and Chapter 4. And believe me, understanding the difference is everything. This brings us to the fundamental question every withholding agent has to ask themselves before they do anything else. Does this payment fall under the rules for Chapter 3, or does it fall under Chapter 4? Because the answer to that question is going to dictate everything that happens next. This table breaks it all down. The easiest way to think about it is that Chapter 3 is kind of the general catch-all rule. It applies a default 30% tax on a broad category of income. But Chapter 4 is different. That came from the FATCA law, and it's much more of a surgical tool. Its whole purpose is to stop US taxpayers from hiding money and assets in overseas financial accounts. And right here, this is probably the single most important, non-obvious rule in this whole process. A payment might look like it falls under both sets of rules. So what do? Well, the rule is simple. Chapter 4 always wins. It takes priority. It's the trump card. The IRS wants to enforce those FATCA rules first and foremost. Okay, so now that we know who the players are and we understand the rules of the game, let's talk about the data itself. What kind of income actually needs to be reported on a Form 1042S? The IRS has a catch-all term for this stuff. They call it FDAP income. It stands for fixed or determinable annual or periodical. Yeah, it's a mouthful. But just look at this list. We're talking about almost everything you can imagine. interest, dividends, rent, royalties, even pensions and gambling winnings. It's an incredibly broad net. So what happens if no tax is actually due? Maybe there's a treaty in place. Do you still have to file? Yes, you absolutely do. And there's a new rule that says you have to put in a specific exemption code anytime the tax rate isn't that default 30%. By far, the most common one you'll see is Code 04, which means the income is exempt because of a tax treaty. This is where you can see the form is actually a tool for enforcing those big international agreements. All right, let's switch gears for a minute, because this next part is a really practical, time-sensitive update for anyone who's actually filing these forms. The way it's been done for years is about to change completely. Let me make this as clear as possible. The old electronic filing system, which is known as FIRE, is being shut down. It's being retired. Starting with the forms you file for the 2026 tax year, which are actually due in early 2027, that system will be gone. The new system is called IRIS. That stands for Information Returns Intake System. And just so we're all on the same page, this is not optional. It's a mandatory move. Starting January 1st, 2026, for that tax year, IRIS will be the only way to file a 1042-S electronically. It's a hard deadline, and anyone who files these needs to be getting ready for it now. So we've covered the what, the who, and the how. Now let's wrap this up with the most important part, the why. What happens if you get these complicated rules wrong? What are the real-world consequences? Well, the financial risk is very, very real. The base penalty for failing to file a correct form on time can go up to $340 per form. And that's just the start. If the IRS decides you intentionally disregarded the rules, the penalty can skyrocket with no maximum limit. But honestly, the ultimate risk is summed up perfectly in this one sentence, pulled directly from the IRS's own instructions. Let that sink in for a second. If you are the withholding agent, you are personally liable for the tax. It doesn't matter if you forgot to take it out of the payment you made, the IRS can and will come to you to collect that money. And that single sentence is why understanding this form isn't just about good paperwork, it's about managing some very serious financial liability.